Good evening and welcome to the Earnings Review, your tech bits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts just to ensure you are furnished with relevant and comprehensive market analysis. Tonight, we focus on Proplastics, a listed plastic pipes manufacturer on the Zimbabwe Stock Exchange. Some quick facts on the entity. The entity is involved in the manufacture as well as fitting of plastic pipes, not just in Zimbabwe, but also in the SADC region. Its product offering is mainly for use in the civils, mining, as well as agriculture, among other sectors. A sneak peek at the entity's timeline: established in 1965 as Promat, this then became Rhodesia's first extrusion factory established in the then Salisbury. In 1994, a key development took place as Promat was rebranded into Proplastics. That very year, Proplastics became a subsidiary of Roberts Construction. And in 2012, a key development would occur in the group as Roberts Construction, now known as Murray and Roberts, rebranded into Masimba Holdings. In 2015, Proplastics was listed on the Zimbabwe Stock Exchange after an unbundling from Masimba Holdings. The entity has gone on to service several clients across the years and has gained a reputation as attested to by the SAZ as well as the SABS certification. Some of its products include PVC piping, polythene piping, fittings, as well as solvent cement. Of note is the fact that its pipes are used in irrigation, mining, as well as the construction sectors. Its clientele ranges from government departments, municipalities, mining companies, as well as construction companies. On to some quick stats where the entity is concerned. With a current share price of 7.20 cents, the entity has a market capitalization of 1.7 billion Zimbabwean dollars. Its share price has moved over 750% since the year started, over which the materials index has moved over 600%. Comparatively, the ZSE All Share has mounted over 621%. Some key shareholders in the entity include Zumbani Capital, which has a 21% stake, as well as the Old Mutual Life Assurance, which has over 19% in the entity. On to some notable developments. In the year 2018, Proplastics undertook the construction of a world-class facility with an estimated cost of $5 million. That factory is now complete and operational, increasing the firm's capacity by over 300%. Of note is the fact that they also opened a new facility in Gweru in the year 2019. This concludes the Halaju section of our show, and in just a moment we will have a look at the operations of the entity. Don't go anywhere. And now joining us for a look at the operations as well as the financials of Proplastics is our very own Chief Analyst at Equity Access, Respect Kwenzi. Respect, good evening and thank you for joining us on the Earnings Review.
Thank you, Ibn. It's always my pleasure, and good evening to you too.
Beautiful. Let's get the ball rolling. I want us to first of all look at their 2019 performance, as well as a look at their trading update, which also spells out how the COVID has affected their operations, then delve into the halajus of how they're actually navigating their operations in the Zimbabwean as well as the SADC terrain. To look at their financial performance over the past year, they posted revenue of 114 million Zimbabwean dollars in historical terms. Turn that into inflation adjusted terms, that's 234 million vis-a-vis a prior performance of 198. However, their volumes took a 26% knock. How do you explain these figures?
Yeah, so I think there are two elements to it, looking at the historical and also the inflation adjusted aspect. In inflation adjusted terms, their growth was actually quite slower or lower than historical terms. So looking at the impact or implication of that, I think it's mainly a volumes-driven outcome. The volumes decline in the prior year actually speaks to the bigger market, which is Zimbabwe, where we saw a sharp decline in terms of aggregate demand. So this is the key dynamic in terms of the top line performance. But I think just as any other company in Zimbabwe, quite some key fundamental challenges there: hyperinflation, erosion of incomes, and they quite mentioned in their results that they're also facing significant tailwinds coming from a very tight macroeconomic environment, which is characterized by high inflation, and this has seen much of their demand side actually coming off on prior years. So this was basically the result from an income perspective, and it affected all income lines right to the bottom line. But also as an implication, I think when you're looking at profitability, the pace of growth was quite higher because they also earn income from the region. And when you convert part of that forex income into the local currency, it boosted a bit in terms of their profitability. So in the PAT in inflation adjusted terms was actually far much higher than the PAT in historical terms, due to the implication of conversion of income from the region, that is from those markets which they export to. And this drove the PAT to a much fairer level. But overall, the core market of Zimbabwe dented income performance. But also looking at the balance sheet position, they seem to have quite a strong cash flow position, which necessitated them to restock and have enough supplies, especially getting into 2020, where we now faced with the COVID situation, and companies need to have a clear pipeline of inputs, especially from the foreign, from the import side. So they're quite strong on the cash flow position, and the 20 numbers attest to that.
Fair enough. And now that you just mentioned their balance sheet, they have a debt to equity position of about 7%. Given the market vagaries that are playing out in Zimbabwe, how important is that matrix there?
Yeah, I think exposure to debt is in two ways. When you have a high exposure to local debt, which is in ZW terms, and we are in an inflationary environment, it simply means your debt becomes lower as inflation increases. So that might be an advantage to a company which is highly geared but with the local debt in an inflationary environment. When you also have a company which is highly geared and the exposure is more on the foreign side, you get to have difficulties in an inflationary environment, because it means your debt levels are actually increasing, and it threatens financial stability of the company. So I think this gearing really speaks to their exposure in terms of more local debt, but they also do have got some obligations due to outside creditors, and these are mainly institutions which fund their pipeline of inputs from outside, but they're also exposed in terms of foreign markets, which makes the situation better, that is in terms of their ability to suit some of these foreign obligations.
At their most recent results presentation, they did indicate that they have an import bill of about $500,000. And now, given the situation where we are currently grappling with foreign currency shortages as a nation, how important is their SADC footprint, and to what extent really can they look forward to growth in that regard?
I think that the decision to unbundle Proplastics, which was taken in 2015, really spoke to creating an entity which had a focused business, and that allowed for more investment into that entity. And as of 2020, a new plant was put in place, like you mentioned earlier, and this simply means it's quite easier to get into the export market. It gives them, it boosts their ability to compete in the foreign space, because they are producing more at a lower cost and more efficient processes and so forth. So I think their regional thrust is quite firm, and it also enables them to possibly counter the losses that we are seeing in the local market in terms of demand. But more significantly, wherever your local currency is also decreasing, like in value, like now, you get to your exports gets to be more favorable. And looking at Proplastics, they have been enjoying this benefit of having to operate with a weaker currency and trying to then push your exports out there. So I think it also speeds up your exports process, and they've been benefiting from that.
I want us to talk about the factory. This increased their capacity by over 300%, and I think they are ranging north of 32,000 metric tons annually. How important is that addition of the factory?
Yeah, like I mentioned, it increases efficiency. That's one of the key areas when you're looking at cost management. But beyond that, that also means that they can now progress in terms of diversifying and pushing more into the region. And when you have got these more regional markets, it diversifies income. It also gives you a chance to also earn forex. But locally, I think it gives them more market share, and they will be able to deliver even some of the products that they were not able to deliver given the old plant. So it increases their local market share, but it also increases their presence into the region, and it gives them the cost comparative advantage, and they might take advantage of the current crisis where we find ourselves in an inflationary environment by pushing more volumes on the outside. So I think this plant, it's a key development. It's a huge turnaround point for the company, which I think it will unlock significant value getting into, say, in the next 3 years.
Fair enough. Now let's look at their clientele base. They usually service government departments, municipalities. This is in addition to construction as well as other agricultural clients. But let's talk about how the leg of government departments as well as municipalities gets to affect their operations. We've got a government that is cash strapped, and a lot of instability is currently hovering over our government. What position does that put Proplastics in?
I think every government is a going concern. There's no government which will ever run out. I mean, governments do change, but the aspect of a sovereign state allows that all governments remain in place, in perpetuity. But what that means is that government will always seek to to do business with the private sector. They will still continue to try to play in the infrastructure development space, and Proplastics obviously is positioned to benefit from some of that business. But I think looking at Zimbabwe specifically over the past few years, of course, rolling out austerity in 2019 meant a tighter budget. But this government has put more emphasis in terms of infrastructure development, and they've set aside over 15% of the 2020 budget in terms of pushing infrastructure projects. But now getting into 2020, COVID hits, and some of those resources had to be redirected. But when you're looking at the order book, it's quite firm, and it's obviously more government dominated. But that's the nature of the economics of the country. We certainly can't run away from it. So the exposure to government is not really a problem, but really you want to have exposure to a government which has got the capability to pay when the times are due. So whenever you're running with significant treasury bill exposure, it actually means that your value is eroded in a way, but you got to manage that kind of crisis. So I think it's one of the drawbacks, but it also means that they will continue to have business in perpetuity outside of the present crisis that we're facing as a country.
Proplastics also plays in the agricultural sector, providing irrigation and material in that regard. With the instability, or should I say the lack of predictability in terms of the climatic conditions in this part of the world, what opportunities could they actually tap into?
I think it's too early to write off agriculture as a sector which can contribute positively to economic growth at this point. I think looking at the structure of this country, mining and agriculture are pivotal sectors in terms of economic development. A significant part of our growth emanates from those two key sectors, all things being equal. But of course, the past few years have been quite turbulent, issues to do with climate change. But our country anchors on that respective sector together with the mining sector. So I think positioning yourself or positioning itself in terms of the agricultural sector is actually a good thing, given how our economy is structured. So I don't think that we need to write it off as yet. It's actually going to rebound. It's just the past few years which have been a bit harsh. But I think going forward, agriculture returns are going to possibly be better off than most of the sectors, as was the case in the years when Zim was a breadbasket of the Southern Africa.
Now, I want us to have a look at their trading update. One of the key issues indicated there is the fact that in the first quarter of the year, right up to the 31st of March, their sales volumes decreased by 14%. What could be informing such a matrix?
I think getting into 2020, we're still facing the same challenges as last year. Aggregate demand is low. And this is stemming from the fact that we still have got serious value erosion that's going on. If you're looking at inflation statistics, we're sitting at 755.55% as at May. And that's really a very worrying statistic. If you then look at what's been causing that, it's exchange rate losses. Exchange rate depreciation. And the exchange rate in terms of the ZW dollar against the USD has softened by over 95% on the parallel market since 2019 February. So I think those statistics are quite telling in that you can't keep on procuring or you can't keep on buying at the same rate as you were. In fact, the rate at which incomes are growing in nominal terms is quite lower than the rate at which inflation is actually increasing. And that really speaks to the broad macroeconomic environment. So when customers are faced with such a crisis, what they simply do is to look at what they get, what they have in terms of income, and to say, how best we split this little income that we now have. And they obviously tend to get to procure basics ahead of all other goods. So I think this is the predicament that the broader economy is facing, and we're still having it in 2020. And obviously they're still in that same situation.
Now, also from the same trading update is the fact that they're highlighting that given the volatility brought about by inflation, they are ensuring that every transaction that they get into is on a cash upfront basis. What's your take on such a strategy?
Yes, I think it's quite important looking at the aspect of value preservation, because you don't want to be pushing volumes and failing to recoup what you have put in terms of your investment. And so I think that's the best way to preserve value. You need to have a small lead time in terms of where you push your product and at the point at which you also get to be paid. So I think that's the model, and most of the business sector is actually moving in line with that model. It also allows you to be able to procure and to have enough in terms of your pipeline of inputs. So I think it's quite fair for them to do so as a way of preserving value. But I think further in that line, and given the decline in terms of volumes, they're also trying to rationalize their operation. They have quite highlighted how they've looked at the aspect of employment, and all contract workers, those who are on contracts, they actually suspended and laid off some of those workers. So I think it talks about the issue of trying to preserve value, the issue of trying to rationalize so as to push the entity forward. So this is exactly some of the things that they're doing in light of the environment.
And now to sort of zoom out of Proplastics and look at the manufacturing sector against the background of the Zimbabwean economy, we've seen a lot of currency flip-flop tendencies from the central bank. One day is this, the other day is that, and at the very moment, government has issued a statement indicating that some civil servants will be paid in foreign currency. Where does that put business in general?
I think it's twofold. You might be able to be selling your goods in a stable currency. In this case, you're now being allowed as a business to charge your goods in terms of foreign currency. But now, I think one of the fundamental issues I have with this present development is that this money which we are saying is $75 is something that you cannot recoup in terms of actual USD. You can only be able to transact with that money. So suppose you buy pipes at Proplastics. It simply means that within Proplastics account, they have a certain group of deposits or of cells that are tagged possibly special dollar, whatever it is. Why? Because they're not easily convertible, or they cannot easily recoup them as US dollars. So they have to wait on government to actually liquidate those funds. So I'm seeing a situation where businesses would want to then get to recoup those funds and they face a lag. Or maybe we get to a point where the Reserve Bank actually says we are buying these at a preferential rate which is lower than market, and you get to then lose your income. So it's good for the consumer, but it might not be good for business, and it might not necessarily also be good for the economy in general. Why? Because it puts pressure for government, because once you get paid in that special dollar, you also want to import against that dollar, and RBZ might not have enough liquidity at that point to suit your import, whereas you already have got that USD, special USD in your account. So I think it's really a challenge, because they are not liquid on hard cash. If they were, this was not going to be a special dollar. It was supposed to be real USD. You can withdraw your funds, you can transfer your funds, but you can only procure. And when you procure, it's now between the government and the company. So companies might be left with this special dollar, which gets us back to your 2018 scenario of 1:1. So you procure, you record that you've got certain US dollars, but you now want to use those funds to import something, and you start to face challenges with the central bank. So I think we're going back to where we're coming from. But for now, it seems good for the consumer, but they really have to end the dollars. They really have to get the economy to become stable for either of the currencies to work well.
Well, thank you, Respect, for the enlightenment. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday, 7 p.m. Central African Time on this very same platform. From the Equity Access team and I, Danki, and ciao.